irrecoverable debt and provision for doubtful debt. Okay, another name for irrecoverable debt is another name. We call that bad debts. Bad debts is another name of irrecoverable debt. And what is the meaning of irrecoverable debt or bad debt? Is the debts that cannot, it's actually confirm, cannot collect from trade receivable. Okay, you already do some sort of try to get the money. Example, you email them, send a letter, send a lawyer notice, or you already go to the office, you try to get the money, you confirm that you cannot collect the money. Then whenever you confirm that you cannot collect the money, what we do is we will record as irrecoverable debt. We cannot recover the debt. Okay, first thing. Second one is provision for doubtful debt. Okay, what is the meaning of provision for doubtful debt? Provision for doubtful debt is the debt that the company or we estimate cannot collect from trade receivable. Okay, it's just an estimate. Okay, see the keywords. Okay, one is irrecoverable debt is confirm you cannot collect the money. Okay, but your provision for doubtful, if you see the word doubt, you have a doubt on it. Okay, doubtful debt. Okay, it's a estimation that you cannot collect. Okay, you estimate. Okay, we accountants are prudence. We will estimate the loss. Okay, we will estimate in the loss, future loss. Okay, now, okay, we need to more prudent now. Okay, we continue read. Irrecoverable debt. What is the irrecoverable debt? Right, irrecoverable debt, or another name is bad debt. We call that bad debt. Okay, when the goods are sold on credit, you know what's on credit, right? On credit means we sell on debt. Okay, the customer is allowed to pay. The customer is allowed to pay for the goods later. Okay, later date. Okay, they can pay later. It's a credit sales. It's a credit sales. Okay, there is always a risk. Okay, there's always a risk that the customer may not pay for those goods. Okay, and irrecoverable debts is the amount owing to the business which will not be paid by the credit customer. Okay, okay. The real definition is an amount owing to a business which will not be paid by the credit customer. Okay, this is my explanation for irrecoverable debt. And if all reasonable steps to obtain the payment have failed, okay, or what are the reasonable steps? Example, send a letter, okay, send a legal notice, or you go to the office, ask for the money, okay, can all the reasonable steps lah, okay, is failed. Okay, the guy still cannot pay, or the guy bankrupt, or the guy run away, or something happened, then we need to write written off the debt. Okay, what is the meaning written off? You cancel his debt lah. Okay, we just cancel his the debt. Okay, because we cannot keep the money, keep the guy's debt in our book. Okay, next one is when the debt is written off. When the debt is written off, we will debit irrecoverable debt. Why irrecoverable debt is debit? Because it's your expenses. Expenses increase, and you will credit the trade receivable, the guy's name lah. Okay, you will credit the trade receivable. Why you credit the trade receivable? Because trade receivable is asset. You want to minus means asset reduce is credit side. Okay, and after you record this, okay, whenever the bad debt or irrecoverable debt happen, you confirm the guy cannot pay, so our record will be debit irrecoverable debt, credit trade receivable. Okay, but end of the year, you remember, okay, all the accountants, end of the year, what we do is we'll close all the income and expenses. We'll close all the income and expenses, will transfer to income statement. Okay, here irrecoverable debt is your expenses. So what we do is we will credit the irrecoverable debt. Okay, we credit the irrecoverable debt. Why we credit? Because we minus lah, we take out from irrecoverable debt, we transfer to income statement. We transfer to income statement. I repeat again, whenever the bad debt happen, whenever the irrecoverable debt, you confirm that you cannot collect, so what we do, we'll debit the irrecoverable debt because it's your expenses increase. It's your loss, it's a loss increase. And then we'll credit the trade receivable. Why we credit the trade receivable? Because your asset decrease. Asset decrease means a credit side. Then after that, end of the year. Okay, at the end of the year, the basic rule is we will close all our income and expenses. The basic rule is we'll close all the income and expenses, will transfer to income statement. Okay, here we have irrecoverable debt. This irrecoverable debt is your expenses. And then we want to transfer to income statement, right? So you minus, like you take out for expenses. So we credit the expenses, we debit to income statement. Okay. Okay, writing off irrecoverable debt. Writing off irrecoverable debt is an example of the application of the principle of what? Do you know? We have a lot of principle. Okay, we minus the debt that we cannot collect. We minus that the debt that we cannot collect is what? Is actually prudence. Why I'm telling this is prudence? Because we don't want overstate. What's the prudence? Prudence means actually you cannot overstate. Cannot overstate the trade receivable. Okay, because you confirm you cannot collect the money, then what for you want to keep the money, keep the trade receivable in your books? Okay, it's if you confirm that you cannot collect the money, and still if you don't want to return off the money, the amount is still there, the trade receivable list is still there, means you're overstating the trade receivable. So when we know the guy cannot pay, we just minus the guy's debt. Okay, because we want to follow prudence. We cannot overstate our asset. Okay, here the trade receivable is our asset lah. Okay, this is the first part. Okay, sometime this may happen. Okay, 2000 example lah, 2010. Okay, Mr. A passed away. Okay, Mr. A passed away. So I write off lah. Okay, I write off his debt. Okay, I try to contact his family. The family members are not responding to me. Okay, when Mr. A passed away, died already. So I write off his debt because I know he cannot collect. So maybe after a few years, okay, after a few years, 2013. Okay, 2013, Mr. A came to my office. Okay, let me clarify. Okay, who died? Mr. A, capital A died. Who come back? Small a. Small a is actually who? Maybe his son. His son come back and then come to my office. Okay, and then pay the debt. Okay, pay the debt. So when the guy died, I record as my irrecoverable. Actually, I already go to the family members. The family member didn't respond to me. I sent letter, I sent legal. I have taken all the reasonable steps. Then no response. So what I did is I record as my irrecoverable debts. Irrecoverable debts. It's my expenses. After that, what happened? After a few years, I don't know what happened to his son. His son get to know that before the father died, the father owe me. Then the son come to me, and then the son pay me. When the son pay me, I call that recovery of debts written off. Recovery of debt written off. Okay, this is my income. This is my income. So our next topic is recovery of the bad debts. So whenever irrecoverable debt, it's my expenses. Okay, I recorded. Okay, normally this thing will happen after few years. Okay, then the guy come back and pay us. Recovery of the debts written off. That one is my income. My income. Okay. This one is nothing. I erase this. Then we continue. Okay, recovery of the debts written off is, we call that bad debt recovered. We call that bad debt recovered. Okay, what is bad debt recovered? The debt that we written off previously, assume that we cannot collect the money, but the guy come back and pay you. So we see the debt written off may recover its credit customer pay some or all. Okay, sometimes they pay some of the debt, or they can pay all, okay, of the money they owed. Okay, after the amount is written off, they come back and pay. Okay, to record this recovered bad debt, we have two methods. Okay, we have method 1 and also method 2. We're going to see the both method. Okay, method 1 I will record in the red color pen, and method 2 I record in the purple color. Okay, so we learn the both method. The first method, there's no name for this method. But I just use red color and purple color. Okay, first one is red color. Whenever you receive the money, the guy come back and pay you, we will debit the bank or cash lah. Okay, bank or cash, and then we will credit the debts recovered. Okay, debts recovered, not debts. Sorry, debts. Okay, debit the bank or cash, credit the debts recovered. Okay, this is the first step. Or we have another one step. Okay, method which is the purple color. Okay, another one method is we will debit the bank or cash. Okay, we debit the bank or cash account, and then we will credit the credit customer or the trade receivable. We credit the credit customer. Then after that, we debit the credit customer or trade receivable, and then we will credit the debts. We credit the debts recovered. Okay, this is the another one method. Okay, but basically the method 1 I will call this direct method. Method 2 I call indirect method. Okay, direct method and indirect method lah. Okay, we have two methods, but actually if you just look at the answer, it's roughly same only. Can you say not? You debit the trade receivable and credit the trade receivable. So trade receivable becomes 0. So we have the left account is only bank and debt recovered. So this is directly we record the final answer. But this one we do step by step. Okay, and then next one is at the end of the year, we will debit the debts recovered. Why we debit the debts recovered? Because debt recovered is your income. We want to transfer the income to income statement at the end of the year. So we'll debit the debts recovered. We'll credit the income statements. Okay, credit the income statement. And then we have another one method. Okay, which we will credit the irrecoverable debts. Okay, we will minus the irrecoverable debts. So, but in IGCSE, most of the question, we will use method 1. We will use the method 1, which is whenever whenever the written off happen, okay, whenever the guy come back and pay okay, we will debit the bank, credit the debt recovered. We recovered the money. Okay, at the end of the year, we will debit the recovered and credit the income statement. Credit the income statement. So we use method 1 lah. Okay, the method 2 I just tell you for extra things lah. Okay, most of the time we use method 1. I've seen a lot of IGCSE question, all they use method 1 only. Okay, so now can you pause this video? Can you pause this video and try to do this particular answer? Okay, what debit, what credit? I give you like a few minutes. I take few minutes. Pause this video and then do this answer, and then you continue lah. Okay, if you're done, then I continue. Complete the table to name the accounts to be debited and credited. Sold goods to Sadia. Sold goods to Sadia. Did you receive the money? The question didn't say anything. If the question didn't say anything, it means you haven't received the money. So I will credit the sales because it's my sales lah. Sold goods means it's my sales. To Sadia, and I debit the Sadia. Why debit Sadia? Because Sadia is my trade receivable. Sadia is my trade receivable. I sell to Sadia, Sadia didn't pay. After that, Sadia, a credit customer, yes, paid 210 by bank transfer. Okay, then I will debit bank, credit Sadia. Sadia is my trade receivable. Okay, debit bank because I receive money, credit Sadia because the guy's account reduced. The balance of the Sadia's account 30 was written off. This 30 is from last year, maybe last year. Okay, maybe from last year the guy didn't pay. So what we do is we written off. We written off. So whenever you written off, we will debit irrecoverable debts. Debit the irrecoverable debts, and we will credit Sadia, because we minus Sadia's account. We already asked the Sadia to pay, the Sadia cannot pay. So we will minus the guy's account and we will debit the irrecoverable debt because written off. The guy cannot pay. Okay. And next one is the total of the recoverable debts account. Wait, okay, the total of the irrecoverable debts account 478 was transferred to income statement. Okay, whenever you transfer to income statement, we will debit the income statement. Okay, debit income statement, credit total of what? Total of what? Irrecoverable debts. So credit the irrecoverable debts. Okay. If you have any question, you just message me lah. Okay, you just message me. I can explain to you your doubt lah. Okay, so these are just a simple debit and credit lah. Okay, we move on to the next part. Example 1. Okay, we read example 1. Sanjay is a trader who sells goods on credit. Offers a customer a cash discount of 2%. Okay, offer 2% of discount if they pay within 30 days. If they pay within 30 days. Okay, we continue. Sanjay's financial year ends on 31st December. So every year on 31st December, they will close their account. Okay, no problem. Sanjay sold goods 400 on credit to Ben's store on the 1st February 2012. Okay, what are the important information? I want to know the date. I want to know you sell to who. I want to know how much. And of course, it's on credit lah. Okay, on credit. Okay, continue. The account was settled by the check on 28 February 2018. Okay, on the 28th, they pay me by check. Okay, they pay me by check. Okay, these are the important, all the important I highlight lah. Okay, on this date, Ben Store purchase further goods 150. So they buy 150 on credit. Who? Still same lah, same guy, Ben. Okay, Ben buy 150. We sell to 150 to Ben. After many attempts, recover the amount due. Sanjay wrote off the Ben's account. Okay, as an irrecoverable debt on 30th December 2012. On the 30th December 2012, Sanjay received a check the bank store under 50 on 31st October 2013. Okay, wait. This 31st October 2013 is the following year. So I put in a red color lah, the following year. We received the 150. We received the 150 by check from bank. During the year ended 31st December 2013, Sanjay write off irrecoverable debt of totaling 820. Okay, wait. This 820 is not related to bank, it's related to the other people. Okay, who is that? I'm not very sure lah. Okay, this is for other few people. I don't know who are they. Okay, now I continue. Write up the following account in the Sanjay's ledger for each 31st December 2012 and 2013, and also bank's store account, irrecoverable account, and bad recovered. So we need to do 3 accounts. We need to do 3 accounts. We do one by one. Okay, first one we need to do for 2 years. Okay, first one I'll do the bank's account. I do the bank's account. Wait, let me adjust a little bit so we can see the full one. Okay, first one, I want to do the Sanjay's account. Sold goods 400. Sold goods 400 to 1st February. So I go here, I write 2012. February 1st. Then right here, sales. How much? 400. Okay, I already record this particular information. This particular information I recorded. Okay, how to record is debit side down because it's your trade receivable. Bank is your trade receivable. Whenever you sell, trade receivable increase. When trade receivable increase, I'll record in the debit side. Okay, the date. Another account is sales. Sales will be credit. Sales account. We go to the sales account, we'll credit the sales account. But now we are not doing the sales account, we are doing trade receivable account. So trade receivable will be debit side 400. Okay, after that, what happened? We see the question. The account settled on the 28th. Okay, on the 28th, the guy pay me. So I go to the credit side, 2012, on the February 28th. On the February 28th, I write a bank up because the guy say by check, right? Let me double check. Yes, settle by check. Settle by check. So this one, I done already. Next one. How the amount? The amount is 400 because the guy. Oh wait, I got some problem here. What is my problem here is that we sell on a 1st February and the guy pay 28th February. The guy pay within 1 month or not? Did the guy pay within 1 month? We sell to the guy 1st February, and then the guy pay on 28th February. So is it within 30 days? Yes, it is within 30 days. 30 days. Okay, if it is within 30 days, we must give them a 2% discount. We must give them 2% discount. So let me calculate how much the discount. Okay, the discount is 400 times 2%. So can you calculate how much? 4%, 4,000, not 4,000, sorry. 400 times 2%, you will get 8 ringgit. So $8. Then how much you pay? This is our discount. Wait, let me label. The discount is $8, and then how much you pay? You will pay 400 minus 8. 400 minus 8, you will pay 392. 392. So $8 is my discount. I will pay 392 only. Why there's a discount? Why there's a discount? Because the guy who's the bank pay within 28 days. Okay, if less than 30 days, we must offer that guy discount. Don't forget the discount. So it will be in a credit side. How much the guy pay? The guy will pay 392, and then the discount. This is what discount allowed or discount received. This is actually discount allowed, but actually you just write discount is good enough lah. Okay, if you want to write discount allowed also can. Okay, if you want to write discount allowed also can, but actually if you write discount is good enough. Yeah, wait now. Discount allowed, yes. Okay, how much is discount allowed? Is 8. Discount allowed is 8. Okay, we are done with the second transaction also. Okay, the first one, the third one. On this date, the bank stop purchase further under 50. So the guy buy further under 50. So who's that guy? Ben, still in the bank. So what I do, I go to the debit side, I write 150. The date will be 28 February, and then we write here sales. It's a credit sales of 150. After that, what happened? After many attempts to recover the amount due, okay, we already tried to collect the money. We cannot. We failed to collect the money. When we fail to collect the money, what we do is Sanjay wrote off. We are the Sanjay. We work for the Sanjay company. Sanjay wrote off the bank's account on 31st December 2012. On the 31st December 2012. So this is the following transaction. Then I go here in the credit side now. Okay, the credit side, I write December 30th. December 30th, I'll write irrecoverable debts. Okay, I write irrecoverable debts in the credit side because I want to minus lah. Wait, now let me adjust a little bit. Okay, irrecoverable debt. How much? The under 50 lah. Because the 400, the guy pay me ready. I give discount ready. After that, this under 50, the guy didn't pay. See, the guy bought on February 28. The guy bought on February 28. But until the December, the guy didn't pay. So on 30th December, our boss, Sanjay, our company lah, the Sanjay, decided to write off the amount. So I will credit the trade receivable account. I credit trade receivable account, and I will debit the irrecoverable debt. I will debit the irrecoverable debt. How much? 150. So I write here 150. The date will be 2012 December 30th. And this one will be, I write Banks Stores. Okay, because we know the name Bank Stores. Okay, after that we continue. I think that's it for this year because this is already 2013 already. So this line for 2013 already. So I don't want to talk about 2013. This 2012, we settle the 2012 first. So this one, we balance up. Which one bigger? Debit bigger or credit bigger? Debit bigger or credit bigger? Both are same. When the both are same, what we do is we just total up 550, 550. Okay, we just total up 550, 550. Okay, then you need to draw a line now. Okay, the line right now, let me draw a line. Okay, we draw a line here. We draw a line here. We draw a line here and draw a line here. Okay, nice. Okay, after that we continue. This one also done already. This one also done already for the first year. Under 50. Then here I write 2012. When we close on December 31st. Okay, this one will transfer to where? The irrecoverable debt. Irrecoverable debt is your expenses. Expenses, end of the year, we transfer to income statement. Income statement. How much is the income statement? 150. Income statement is 150. 50. It's an income statement, yes. Wait, okay, income statement. Am I done? Yes, I'm done. So after this, I want to draw a line for this year. Double line like this. Double line like this. I write here, under 50, under 50. Okay, this one changed to red color because it's balancing, right? Okay, I'm done for 2012. Okay, first year I'm done. Okay, next one. Next one is 2013. Let's do for 2013. Okay, Sanjay received a check. Sanjay received a check from who? From Ben. Sanjay received a check from Ben under 50 on the 31st October 2013. So this is what? Bad debt recovered. This is bad debt recovered. So bad debt recovered, we record in the bad debt recovered account. So we follow the first method. We follow the first method. I go to the debts recovered account. Debt recovered account is an income. Income will be in a debit side. So 2013 October, is it October? Yeah, 31st October. 31st October. October 31st, and then I write here bank. Okay, how much? 150. Okay, we follow the first method now. That's why I write bank. If second method, here we write the guy's name. Okay, under 50, I'm done already. Anything happened in the 2013? On the wait, I highlight this. Okay. Okay, this highlight is actually step. This is the first step, second step, third step, fourth, and fifth. After this, now during the year ended 31st December 2013, Sanjay wrote off. Okay, write off or wrote off irrecoverable debt of 820. So we cannot collect 820. So this is irrecoverable debt. So I go to my irrecoverable debt, will be in a debit side. Will be in a debit side. The year will be 2013. Will be debit side December 31st. Okay, because the guy said 31st December 2013. December 31st. How much? 820. But do you know who's the guy? Which guy didn't pay? The last year, 2012, we know bank store. So we write here bank store. But now you don't know who are the guy. So what we write? We just write trade receivables. Since you don't know the name. Since you don't know the name, we just write trade receivable. Okay, trade receivable. Anything happened this year? No, nothing. We finish. Okay, 2013 got only 2 transactions. Both transactions we recorded. So now we balance up this account. How to balance up? Same thing. 2013, we write here December 31st, it will transfer to income statement because irrecoverable debt is your expenses. All the expenses we transfer to income statement end of the year. So this is 820. And then don't forget to balance up because this account done already. We balance up 820. After that, don't forget to underline. We need to draw double line. Line is very important now. Okay, every time you balance up, you need to double line. Okay, this one also I draw now. Okay, this one also we need to balance up. Okay, debts recovered. If debts recovered is your income. You remember? income and expenses, both will transfer to income statement. Okay, 2013, we write here December 31st, then we write here income statement. Okay, income statement, how much? 150. Okay, it's 150, will transfer to income statement as my income. And the total will be 150, 150. Done already. Okay, this is example number 1. Okay, I repeat again. Step number 1, we record how much we sell, and then the guy pay or within 30 days. So we record the discount. After that, we sell again to that guy, but this time the guy didn't pay. We wait until December 30th. We sell on the 28th February. We done until December. Okay, so how many months? The guy still didn't pay. When the guy didn't pay, we record as a irrecoverable debt. Irrecoverable debt, we credit the trade receivable account. We debit the irrecoverable debt. After that, we transfer to income statement. After that, we transfer to income statement. Okay. The second year, what happened? The guy come back and pay us. When the guy come back and pay us, we record as a debt recovered. We record as debt recovered. We record as a debt recovered. Credit side of the debt recovered because it's your income. Income will be credit, bank will be debit. Okay. This one also done. After that, we realize there's a irrecoverable debt for this year. Irrecoverable for this year is 820. We debit because it's your expenses increase. Okay, after that, that's it. We balance up, transfer these expenses to income statement, transfer this income to income statement. Finish. That's it. Example number 1. Okay, what you can do? You go back to the example, do again. You do yourself again. Then you'll know you understand or not. Okay, any problem, you can comment now down here, or you can WhatsApp me. Okay, that's it for example number 1. We have another one lesson. We will do the next YouTube. Thank you.